So now, last but not least part of the chapter, let's talk about fraud detection and what exactly the auditor's responsibilities are with respect to detecting fraud. So starting off with this chart, which I think is pretty fun, this chart shows us what the common methods of detection have been historically for fraud. And you'll notice that tips are kind of the most frequent way fraud is discovered. And what is particularly disturbing about this slide is you can see fraud is discovered by accident 6-7% of the time, whereas fraud is discovered by external audit 3-4% of the time. So we have a worse track record as external auditors than just accidental discovery of fraud, which basically makes you realize, hey, external auditors are pretty bad at detecting fraud. And part of this may stem from the fact that the auditing standards tend not to really distinguish between the auditor's responsibilities for errors versus fraud. So really what the auditing standards tend to do is distinguish between the auditor's responsibility to discover material misstatements versus immaterial misstatements. So the key concepts in the standards tend to be, we want the auditor to be responsible for material misstatement due to error or fraud, and they're not responsible for uncovering the misstatements that would be considered to be immaterial. And here's a bit of historical context. Prior to '02, the AICPA's position was, hey, auditors should follow up if they suspect fraud, right? If some red flag leads them to believe there is fraud. But audits aren't designed to detect fraud. Audits are really designed to detect material misstatements, not to detect fraud. So in '02, concurrent with SOX being issued and the PCAOB being formed, the AICPA adopted SAS 99, which established new fraud standards requiring auditors to provide reasonable assurance that material fraud would be detected. So once again, we do see this focus on materiality and less focus on the cause of the misstatement. And SOX and the PCAOB have again reinforced the auditor's responsibility to search for material fraud, but not all fraud. And again, this is why the auditors would tend to focus on financial statement fraud and potential causes and risk factors associated with financial statement fraud, because that tends to be big dollar material fraud. We tend to spend much less time worried about the possibility of misappropriation of assets just because the dollars tend to be pretty small there. So we go through a fraud risk assessment process, and this is thanks to SAS 99 is what put this in place. And so some of the things we do as auditors is we have a fraud brainstorming session, which we'll talk more about on the next slide. We will conduct inquiries of management and others about where they see the risks of fraud. So we'll think about anything unusual we observed in our analytical procedures, our inquiries, and our observations that we conducted. And we'll want to look at non-standard journal entries when they close the financial statements. So let's talk a little bit more about the fraud brainstorming session and what happens. So there's usually 2 fraud brainstorming sessions. One would be during planning, and one would be at something called the post-interim event, which is basically another planning meeting that happens right before we go out to conduct the fiscal year-end audit. The entire engagement team needs to be involved, from staff up to the partner level. And the objective of the session is to brainstorm possible areas where there's risk of fraud. The idea here is you're really supposed to put yourself in management's shoes and try to think like a manager to say, hey, if I were in their shoes and the pressure were there, where do the opportunities lie? Where would I even be able to commit fraud? And where would I want to commit fraud? You'll also emphasize at this meeting the importance of professional skepticism, and usually a partner points to one of the staff ones or interns on the audit and forces them to awkwardly define professional skepticism in front of everybody. They'll be like, what's professional skepticism? And just remember, that's when you have to explain, as the new intern or staff one, that professional skepticism is basically maintaining a questioning mind somewhere between being gullible and believing everything client says has to be true, and between, on the other end of the spectrum, being very skeptical and thinking everything the client says is a lie. So remember, we want to have a happy balance in the middle of that continuum where we don't think everything's a lie, but I'm not going to believe everything you say either. And so research has discovered this fraud brainstorming session can actually be much more productive if it's done in an electronic fashion, where everybody is asked to submit a few written examples of potential fraud risks and kind of to a pot anonymously, and then we can talk about them as a group versus having everybody put on the spot in a face-to-face meeting trying to come up with something. Because when you tend to put people on the spot, your young people don't want to participate because they're worried about looking stupid. And so the partners who have been on the engagement for several years, they tend to be the ones coming up with the ideas. And they're not very creative, so they tend to just use last year's fraud risks as this year's fraud risks. And we miss out on some potentially great new ideas coming from those younger team members. Now let's talk about the auditor's response to risk assessment, documentation, and communications. All right, so first let's talk about evaluation of the audit results when fraud is suspected. If the auditor figures out that a misstatement might be the result of fraud, the auditor should go through a series of steps. First, they should try to obtain the evidence to determine whether the fraud has occurred or not. And we saw that happening in our If You Need Love, Get a Puppy case, right? He just initially suspected it at first, but he didn't know anything. And so they went to try to get more evidence. They're like, let's heavily test these cash transactions because that's where the errors really seem to lie. And let's also try to get an idea of how much money is flowing through these cash transactions on a yearly basis. Like, would this even be material? Is 20 grand flowing through these things, which is not really material? Or are we getting like millions of dollars in cash payments, in which case it could have a pretty material effect on the financial statements? Then consider implications for other areas of the audit. So like if I'm finding AR is misstated, then I also know that sales is probably misstated. Also, if we identify a particular employee that's committing fraud, what other areas is that employee potentially in charge of? Because those accounts could be impacted too. It would be very rare for someone to only commit fraud in one way when they have lots of opportunities available to them. Then we'll try to discuss the matter with basically one level of management removed from the employee we suspect is conducting the fraud. So if we think it's the payroll manager, we'd want to talk to the boss of the payroll manager, whether that be the CEO or CFO, etc. Then we'd want to consult with legal counsel within the firm generally. You could, if you think senior management is involved and if you think the dollar amounts are really material, that's when you could potentially consider withdrawing from the engagement, especially if the board of directors seems against you. So if you suspect senior management, generally you're going to have to go to the board and the audit committee with this stuff. And if they seem to not care, senior management is involved, and we think amounts are really material, that's when I'm like, okay, maybe I just need to withdraw from this engagement and cut myself off from this client. In auditing, I don't think we've talked about it yet, but there's a saying that if you didn't document it, you didn't do it. So documentation is probably the aspect of auditing where I spent most of my time as a staff and senior, not actually doing the stuff, but writing about doing the stuff. So you want to document any discussions you had among the engagement team and with management or with the board or with the audit committee. You want to document all the procedures you did to identify where the fraud was, how material it was, etc. And you want to document the nature of your communications about the error or fraud. So like, did I go talk to senior management? Did I go talk to the board of directors? Did I provide them with a written summary of our findings? We want to include that, and so on and so forth. This slide just summarizes what we already said, which is you want to go one level above the person involved in the fraud to report it. And if you think senior management is involved, that's when we'd want to go to the board/audit committee. The information on this slide is about what the auditor's responsibilities are to communicate about the fraud. This often surprises a lot of people because the auditor's responsibility is really limited to disclosing the fraud to senior management, the board, and the audit committee. Going beyond that and disclosing the fraud to shareholders would not be within the auditor's purview and would in fact be considered violation of client confidentiality in most cases. So in most cases, confidentiality would say, we don't need to disclose this, right? But there could be certain circumstances where it does become our responsibility. So for instance, if we believed that senior management was going out of their way to conceal the fraud, not tell their shareholders, and because of that, the financial statements contain material misstatements, either this year or in historical years. That's a case where we would be required to disclose the fraud outside of the client, and generally that would be to regulators, not a straight line to the shareholders. Also, if you have the inquiries between predecessor auditor and successor auditor, that could be an instance where you'd be required to disclose the fraud. Also, in response to a subpoena, we always know we want to comply with subpoenas. Now, what's interesting is oftentimes the word on the street that I heard was if the audit firm does receive a subpoena and you're, as individual audit team members, you're pulled up in court onto the stand to answer questions about fraud, what I've actually heard is the guidances that you get from the audit firm's lawyers is to, number one, stick to information that's already documented in the work papers, because that's our best record of what happened at the time, what we were thinking at the time, and so on. Or number two, simply state that you do not recall. So the audit firm's lawyers are going to be clear that they don't want you to have to speculate. They don't want you to have to go back in your memory if something isn't documented in the work papers. They'd rather you just say you do not recall what is going on here. And the audit standards actually, interestingly, don't provide a lot of guidance as to what to do if everyone like senior management, the board, the audit committee is all in cahoots. What do you do? So the guidance there tends to actually be to talk to your audit firm's lawyer, basically, to consult with legal counsel and figure out what exactly your responsibilities are. The end of the line, if you believe they're all corrupt and colluding and committing fraud, is you do issue a letter to board/audit committee saying, I give you 24 hours to disclose this fraud to regulators, or I will. And then if the 24 hours expires and they don't, that's when you're generally able to make a disclosure to the relevant regulator, say the SEC, saying that you think your client is potentially committing fraud. But for the most part, all that responsibility is going to lie in the hands of senior management, board, audit committee to be making those disclosures to regulators.